Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to the Dentist Money Show, where we help dentists make smart financial decisions. I'm here. My name is Ryan, by the way. It's nice to be with you. And I'm here with Matt Mocock. What's happening, Matt?
Here Mocock. We are. New year, no nicknames.
New year, new us?
New year, new us. Yeah, I think so.
New year, new us. We can
Ryan,
do nicknames.
Really quick. Yeah. Can I show you the...
Yes, I don't even know the question, but yes.
Perfect. I just yes, no matter what.
Yeah, I don't care. Yeah, let's go.
I'm going to show you and the good people on YouTube my kids' favorite Christmas present they received.
Okay.
This past Christmas.
Out of all the planning, spending,
out of all
everything.
Of the things.
Yeah.
Their favorite present. I'm going to just show you here. Classic whoopee cushion.
Let's hear it. Give it a little squeeze.
Should we give it a little
for sure.
Here we go.
Yeah.
Ready?
Let's go. Yeah.
So is that good? You want it again?
Yeah.
I'm sure this will get cut, but
why is that the funniest thing I've heard?
Dude, my kids
that
love
still
it.
kills.
They
a classic whoopee cushion.
My kids will sit it like on a chair or like the coffee table, and they'll be like, "Dad, come on over and have a seat." And like, obviously, I can see what's there, and they just love it. Hold on.
I gotta do this now. This is like probably like another episode. When was the whoopee cushion invented? Let's see. This thing is just a classic going back to I mean, it's been a good, just one of the best things ever. 1930. It's created by JEM Rubber Company in Toronto. Originally experimenting with rubber air bladders, accidentally made a flatulent sound. They realized
it had to be an accident.
They initially tried to sell it to Samuel Adams, the novelty company, not the beer. But they thought it was too crude. Another company picked it up instead. Wow.
It's amazing.
It's 1930. So
well, even better, this is the self-inflating. So like the old school ones, you like blow them back up. Yeah. This just self-inflates.
I'm so happy we started with this. Do you think it would be fine by our marketing editing team if before every question today? Okay, by the way, today's Q&R, question and response. It's not Q&A because we don't necessarily think these are answers. No, these are just responses.
Have words to say.
Matt, where do people submit questions again? On our website, dentistadvisors/podcast.
Yeah, dentistadvisors.com/podcast. I'm pretty sure, let me just double check that. I'm pretty sure we are working on getting just an email going. But we've actually had quite a few questions coming in.
Yeah, that's what I was going to say. Go there. A couple of our questions today come from there, and then a couple come from
dentistadvisors.com/podcast.
Podcast, okay. And then a couple come from the Dentist Advisors discussion group on Facebook. Yep. Post there. Anyway, this is where they come from. What would marketing say if before every question you did a whoopee? Question number 1?
Did you hear that?
No. No.
Hang on.
Okay.
Question number 1?
Yeah.
We're the worst. Okay. Let's go.
Question number 1 comes from, we'll just do first names. Norman, periodontist. He says, he says, I'll just read this here, but the question, direct indexing and enhanced direct indexing is a smart financial decision, and to whom would it apply? It's more of a question. It sounded like it was a statement. So he's saying, who is a good candidate? Who benefits from? Who's the right person for direct indexing and enhanced direct indexing? Now, we're going to have to assume what he's meaning here by those two things. My assumption, and then you can tell me what yours is if it's different. Direct indexing is when, an index, S&P 500, first of all, that's one of many, many indexes.
Yep.
You can go buy an S&P 500 fund, mutual fund, ETF, like any kind. There's more funds than even securities that exist. That tracks the index, mimics the index in all flavors of that. You can buy one fund that does that. Or direct indexing is you literally go buy every security, all 500 securities inside of it, and then you manage the trading and rebalancing of all those securities, adding companies, getting rid of companies. That's direct indexing. And then enhanced, from what I hear this as, and I researched it too to make sure this is, but enhanced would be like the same thing, direct indexing, except you're adding like factor tilts, you're adding emphasis to small cap
or leverage.
Yeah, or leverage.
Leveraging up with either like options or some other form where you're leveraging up on it.
So is that the best way to define it? Direct indexing, enhanced direct indexing, very complex. Yeah. Okay.
There's also companies that do this. We have these capabilities. We don't often do this, but when you get to a certain level of like a level of assets in your amount of money in your account, you can do what's called an SMA, so separately managed account. This is where a lot of firms will do this, where you can still, like, again, we have this capability to do this as opposed to invest in the ETFs or the mutual funds. And it doesn't necessarily mean you always own every single stock in the index, but just enough to represent the index. Basically.
Which these days it's like 7 companies. It's like 80% of the index.
You have 7 companies, you own 40% of the index anyway. There you go. You direct indexed.
Direct index. Well done. All right. So what say you, Matt? I mean, the question's like, who's this good for? Does this apply to anyone? Is it helpful to anyone? How would you answer it? What would you say?
Yeah, I wish we had.
Have you ever seen this before? Have you ever seen like a dentist actually do this themselves, direct index?
I have not seen a dentist. In another life, when I was at Fidelity, this was a bit more common.
Is that when you were on the dark side?
So on the dark side.
You weren't a Jedi yet?
I was not a Jedi.
You were a Sith Lord?
I had not crossed over.
Okay.
By the way, Taylor asked me earlier, we did another podcast, and he's like, you watching The Mandalorian? And like the new Mandalorian? And I was like, I don't even know what that is.
I'm so excited. Yeah.
Should I get into this? Do I need to get
into
this?
The Mandalorian was maybe
was it on Disney?
Yeah, it was Disney. It was a spinoff from The Mandalorian. You know what a Mandalorian is, of course.
No.
Insert whoopee cushion sounds at any point while I'm talking about this. But yeah, so it was a series on Disney Plus, but I think it's a movie now. It was one of their better spin-off series for sure.
Yeah.
They have Mini Grogu, which is a mini Yoda.
Okay.
Awesome.
Got it.
One of their best spin-off series.
Worth
4,000,000%. Yeah. And it's a movie that just came out, right?
Yeah, apparently, and they're doing another one.
All right. Well, that has nothing to do with direct indexing.
Either way, sorry, we digress.
Yeah.
We go on.
I said you were on the dark side. It's
So I wish we had Robbie here because I think he could get into the real intricacies of this. But again, in another life when I was at Fidelity, this came up a lot more. This was a thing with a lot of our clients of like, again, using SMAs. They were still managed by us, like still professionally managed. The number one thing that comes to mind for me of why people even are drawn to this is tax efficiency.
Just going to say tax efficiency.
That's usually, I think, what people are shooting for. Now, there's an argument to be made that theoretically it is more tax efficient because it allows you to do things like tax loss harvesting,
individual
holdings. The other reason I think this works well is you can customize a little bit more around. So like we've had this just last year, we brought on some pretty large accounts, like clients who had pretty large accounts with existing positions. So, we're talking like multi-7-figure brokerage accounts that have like a good portion in like a couple of different stocks. Well, we don't want to just sell out of them. They've got massive gains. You can often build around them with like a direct index.
That's pretty common.
Yeah, that's
building around. Yeah, when clients come over from where they have accounts in other places, building around their existing positions because selling would not be a good tax move, or a good portfolio move at that time.
Totally. And last thing I'd say, probably third reason is if somebody wants to just customize more. So maybe they want to. This is why we don't see it a lot with dentists, because where you would see it maybe more would be, let's say you worked for a large Fortune 500 company and you had like a lot of stock that wasn't even in your portfolio, but like you were getting stock from that company and you wanted to like exclude that from your normal investments. You can do that. Or you want to exclude a certain sector just because of like, I don't know, moral. You have like a moral leaning or something. You can do that more with direct indexing than you can just like buying an ETF.
Now the trade-offs, of course, if you're going to have someone do it for you, cost. It costs more to have someone manage a direct index portfolio. There's just more hours and work spent. And if you do it yourself, it's an enormous time cost.
Sure.
And assuming you do it correctly and well.
Yeah.
And you don't deviate and stray. I mean, here's the thing about this. Let's say you're tracking all these positions, even if you don't have all 500, but you've got enough to mimic an index, and your favorite one, you're tied to it in some kind of emotional way. Maybe it's been riding. You like the numbers behind it, but it's being like downgraded or removed or something in the index itself. I think about this. I'm like, I think most people would probably start justifying why they're not going to follow the index anymore. Be like, I don't know, S&P's thinking this, but I kind of like it for this other reason. I don't think it would take very long if you're doing it yourself before you've drifted from mimicking an index and then just doing your own trading.
Yeah. I would dare say that anyone, even any dentist listening, that even maybe this is the first time they've ever heard this concept and like, I'm interested in this.
Yeah.
Even in that case, you would not do this on your own.
No.
Like you should not do this on your own.
It would be so time consuming. Yeah.
You could come to us, right? You could go to an advisor, an investment manager, and say, I want to direct index for these various reasons.
Mm-hmm.
But they would be the one. I'll say this: they should be the one to manage that for you.
Mm-hmm. Yep.
There's just no way.
There's no way. It would be so time consuming.
Yeah. Okay. To your point, you would lose the plot so quickly.
You would.
It would be like the equivalent of us on this podcast every day. You're just losing the plot. You know what I mean?
Within 10 minutes.
Just all the time. Just saying.
Happy this is the last thing I'm doing today, and I'm so happy. This is how my my work week is ending.
Your weekend is
it's starting off with this.
Yeah.
All right, question number 2 coming up, Matt.
Hit me.
Number 2.
Oh, sorry.
Yeah. Question number 2. This comes from Graham.
The editing on this podcast
is going to be hilarious.
Rough. Sorry, Michelle.
Retired dentist. He says he was a 1980 grad. Okay, retired dentist. I'm going to read this. Watched podcasts for many years talking about the opening of 20 plus new dental schools. This could have an enormous negative impact on the practice of dentistry beyond any other factors like staffing, insurance, DSOs, overhead. I watched approximately 8 excellent dental schools close for lack of applicants. What could we be thinking? I think he's saying, I'm watching dental media podcasts.
Well, I think we mentioned this on one of the 2 cents.
Oh, and you talked about it?
Uh-huh.
Oh, okay. Yep. So you want to recap really fast, and since you already talked about that, sounds like he's just asking about like why this would be. What are we thinking? So maybe recap that fast.
I don't have the numbers in front of me because I didn't know the questions we were going to be.
I know.
Going over.
Yeah, I brought questions. You brought a whoopee cushion.
I just bring a whoopee cushion.
It's needed.
So, if I remember correctly, I was reviewing the report from the Health Policy Institute and the ADA, and they were talking about the growth of dentistry, and how it's still, we were just reviewing all the numbers on 2 cents, and I believe some of the data shows that there was 20 new schools that are, I think, opening this year or that were open last year. I don't remember, but I think it was opening this year in 2026.
Yeah. After some were closing, apparently. Was that in the podcast?
Yeah, and I can try to find it quickly.
If you want to. So those are retired dentists just responding to that feedback. So first of all, thanks, Graham. Thanks for listening to 2 cents and then sending in a question. It's kind of cool.
Yeah, it's going to take me probably too long to find it.
That's okay. Yeah, and he's just probably asking, like, what are we doing? Why would 8 schools close and 20 new open? I have no idea what the answer would be. This is why we call it Q&R. So my response is like, I have no idea. I assume it just probably has to do with demographics and applicant numbers and where people are trying to go to school, which might have something to do with like why do people decide to go to school where they go to school? Is it the school itself? Is it the geography, the location? Is it the cost, especially with dental school costs being so high and still rising? I don't know why everyone's going where they're going to school. But I would just assume it's a demographic and applicant number thing.
And I'm trying to find the numbers.
That is interesting, though. More schools. I wonder if that would actually help in terms of competition for cost of dental school.
Yeah.
Like, I wonder if that is part of reasoning behind like more options for people. Not that I don't know. I have no idea if they'd be any cheaper, But that would make sense if there's just more competition for dental school.
Yeah, and to your point, I mean, why a school closes, it doesn't necessarily, like, I think he's alluding to, will they close because of lack of applications? But I'm like, is that true? Or did they close for other reasons?
Yeah.
So, yeah, no idea. And I can't find. So I just used our little assistant called Google.
Yeah.
Here's what it was. So not in a year. According to the ADA, this is since 2001.
Okay.
There have been 21 new dental school openings in the U.S.
Okay.
So not in a year.
Some have closed, some have opened over time.
Yeah.
That makes sense.
Two new dental schools were opened in 2025.
Okay. That seems reasonable.
Yeah, I think that's reasonable. I was like, 20 doesn't sound right in a year.
That seems crazy.
Too many.
Yeah.
So two last year, about 21 in the last 24 years.
Yeah, less than one per year on average.
Yeah, so that makes sense.
That kind of tracks. All right.
You know what
good question
anyway. You know what we do need?
What?
More hygiene schools. It's or more like
I know.
Something. We got to even that out a little bit.
Still hasn't even changed since 2020.
Yeah.
Popping on over to, this is a question you answered actually, Matt, so you'll be familiar with this one. Popping over to the Dentist Advisors discussion group on Facebook for question number 3. All right, question number 3. Benjamin asks. Benjamin's actually a pretty common poster. Benjamin, thank you.
Benjamin is a regular poster. He's what do the kids call and like when they do live streams, like they call like a super chat or something? I've never done it.
Oh.
I don't know.
On YouTube, super chats?
Yeah, something
you can
like
pay
that.
To have your chat highlighted, like,
or
to
just
the top
you get
of a
like
live stream.
Status when you're I don't know. Whatever it is, he'd be the top of it.
He's a super chatter.
He's a super chatter.
Benjamin, thanks for being a super chatter. He asked in our discussion group, and this is between the Christmas New Year's break. So this guy's like on he's going while the rest of us are off, you know.
I was relaxing and drinking eggnog up. I was typing back to him. I don't even know what I said. Hopefully it was good.
Well, let's see if your answers match here.
Hey.
Every time they don't match, I'll make a farting noise, except I don't have a whoopee cushion.
Deal.
All right. He asks, what's your opinion on keeping your cash equivalent reserves in short-term government bonds like SGOV versus something like a high-yield savings account at some place like Capital One? So you got cash equivalent, just cash on hand. It might be like business reserve, something. Do you do short-term government bonds or high yield kind of savings? And he said, aside from losing FDIC insurance on the first $250, meaning if it's in bonds, are there any major downsides to getting cash from bonds, short-term bonds, if you needed it for an emergency? So, short-term government bonds versus high yield savings accounts for cash equivalents, business cash, maybe even personal emergency funds.
Yeah.
I have your written answer here in front of me.
You have my written answer, so you can check.
Yeah.
And now I remember I was actually in my hotel in Mexico.
Really?
I was traveling.
Isn't that funny when you can recall conversations of where you were when they happen, even if they're very it's not some life-changing conversation.
I was like in my hotel room, on the edge of the bed. Like I was like on my knees, but like using the bed as kind of my desk.
I do that all the time. Like kneel on the floor and
I was kneeling on the floor using the bed.
So weird. I do that.
It is weird.
What an old guy. It's probably like back problems.
And then I get up and I'm like, oh,
that's
my
what I'm
back.
saying. Yeah.
Like, yeah.
But it's better than laying on the bed typing.
Yeah. No matter what I do, I've got back problems.
Everything hurts. Yeah. That's true.
Yeah. So I don't remember exactly what I said, but I can cover, I think.
Yeah. The difference between those two things, maybe the pros and cons of the two risks you might run of the two things.
So from our perspective, using a high yield savings account is going to be better. It's going to be the best way to hold short-term cash. One of the issues with using I'll just say this: when you use a high yield savings account, it's as liquid as it can get, right? That cash is just in an account in your name, as he pointed out, FDIC insured up to $250, and really even more if it's like you and a spouse, because it's $250 per social, so it's like $500. So you get back coverage, and it's as liquid as anything you can have. And
how would you define liquid, just for people listening who might not catch that?
Accessible, as quickly,
no penalties,
no penalties, no issues.
Yeah.
Whereas if you're going direct, right? So banks are using short-term instruments, like government bonds,
to offset their cash lending.
Offset their exactly. Cash, so they're using it. So I guess we'll hit the benefit of that. Whenever you have an intermediary, whenever you have someone in between you and your yield, like in this case, the bank, your yield's going to be lower. Like they're going to take a fee. And in this case, the fee is a smaller yield. The difference is they're taking it. So if you're using a short-term government bond, you will most likely get a little bit of a higher yield, which is a good thing. So there's a reason to do that. Here's the kicker though, or the trade-off you're making. If rates move, right? So if rates go up, or if there's any movement whatsoever, when you're the holder of the bond directly, you are subject to that movement, up or down. So which is your principal. Because your principal. So there is a chance when you're investing in short-term bonds directly that it's not just the yield that you're receiving, but your actual principal amount can go down. Yeah. So it can go up. It's just like any other investment. Yeah. But if you're talking about risk and their use of like an emergency fund and what that money's like is supposed to do for you in your life, the best way to use, or the best vehicle to use in our mind is a high yield savings account. Cash. Give up a little yield to make sure you're not going to lose principal. Yeah, and if you think about like the typical use of money for this might be like excess business savings. It might be like your tax payment that's not due for 8 more months. In reality, the amount of time that you would actually keep it invested and the difference between a high yield savings and then short-term government bonds, I mean, minimal. It feels not only the spread there is probably pretty small, but really everything's time with investing. So on such a short, even if it was a higher rate, such a short period of time, it's just not likely that it'll make enough of a difference for you to want to even carry any kind of risk at all. Short-term money, is either like needs to be immediate, accessible emergency funds, or you're literally going to use it in 3 months, 6 months, even 12 months because it's your tax payment. I just don't think it's worth putting it in anything that could lose value. Yeah. The other thing here too, because I think if I remember correctly, he referenced a specific ETF. Yeah, he gave a ticker. SGOV. Yeah, so that's an ETF that invests directly in short-term government bonds. Yeah, this is what you said. It's part of your answer. Where you're going next. Yeah. Yeah. So the other part of this, I'm glad I didn't forget this since it was like a couple of weeks ago. The other part of this though is, again, we talk about liquidity and access to your funds, although still liquid. If you invest in like SGov in like a brokerage account, there's still settlement times. So it's still going to be more delayed than just holding. So clients like, I need the money today. Yep. Can't today. Yeah. It's going to be at least probably 2 business days. Yeah. You did say that. And then he followed up. He said, yeah, thanks. This sounds good, but it seems like the best option. That makes sense. He said, so maybe something like SGov might be better for a medium to long-term savings for, like a large purchase. It's going to be a down payment for something. It's going to be a car down payment, equipment. It's a few years away, but it's also money, for sure you're going to have to spend it. I'd love that. If it's not emergency fund money and it's project money that's like 2 years away or something. Yeah, great. I didn't even see that he responded. I should pop in there. I gave it a like, which will matter a lot. For sure. I don't even need to answer now. This fourth question. Question 4. Is this number 4? I just checked the time and I was like, there's no way you and I just got through 3 questions in 24 minutes. Here we go. Number 4. That was the best one. That was by far the best one. We're going to get so killed for this. Oh, we're done. We're done. Yeah, we're in trouble. This is like a new high or low. Years ago, many, many years ago, some people remember this. Reese had a chime. Do you remember this? It was like on a block. Yep. And after between segments of the podcast, because we used to have like commercial segments, he would hit the 3-note chimes like GAC. I have no idea what the notes were. But we would finish his segment and hit, and true to form, Reese would be like, this calls for a G major. Yeah. And we have now regressed. We've now regressed. 2026. This calls for a short one. Whoopee cushion. All we have are the options of short and long. Yeah, that's it. Right? Okay. Yep. Pretty much. Your whoopee cushion doesn't have more options. There's no pitch on that. I don't even know if
do you have like a power setting
at this point.
Okay.
I don't think it's usable at this point.
It's not. Okay, this is a good question. I think is its own podcast. Who dove into the comments here? We had a few. Taylor was in the comments. A couple clients in there. Okay, here's the question. It starts off by saying, and this comes from Donald. Shout out Donald. Thanks. Dentist Advisors discussion group. Join it if you're not in there. Go join it and post a question.
Join it and post some questions.
Stuff. He says, starts with, on the topic of 30 total term and the 4% rule. We know where this is going.
Yes.
He says the 4% rule of thumb was based on having a very safe margin to get through the worst possible downturns in a 30-year period based on the Trinity study in 1998. Okay. That seems factual.
I think it was 94, but yeah.
Bengen, that's the guy's name, right?
Bengen, yeah.
Bengen. His newest updates says that 5.25 to 5.5% is probably more true with a better portfolio allocation and more historical data to use now. We did a podcast episode on this a couple of years ago, actually.
I think so, yeah.
On the updated 4% rule, which this would be really cool to revisit because we have been discussing this as a team a lot. He says, in the recent podcast, you guys mentioned changing the 30 total term. Are you guys feeling like it may be too conservative, especially with a globally diversified portfolio and proper planning? He says, I feel like chasing a 95% success rate with success based on not running out of money in 30 years is far too conservative number to chase when the average lifespan is only 78 years. There's a much greater chance of dying well before that 30 years than running out of money. Probably true. He continues, shooting for too high to be conservative also leads to one more year syndrome, where we keep working to build bigger and bigger safety net for mental peace of mind at the cost of more years. He says, I understand recency bias, sequence of returns, etc., but wanted to know your thoughts. Basically saying 4% rule is a little outdated. New data, including the guy who came up with it, Benjamin, says it's closer to 5.25 to 5.5. Your total term Dentist Advisors was based on less than a 4% rule. It was actually based on 3.3 to accommodate for a couple of things and account for a couple of things. What do you guys think about that now? Is that too conservative? Should we not be shooting for something so high? Again, this is its own podcast, Matt.
Yeah,
for sure. This is its own podcast. Rethinking the 30 total term. I love that idea. Yeah. But take it away from here. What are your initial thoughts on this?
Yeah, you're totally right. This is a whole,
for sure. Yeah.
Whole other podcast. But we've also talked a lot about this, and I'll say this. The short answer is I agree with him. I agree with Donald. My thinking on this has evolved quite a bit. I'll also say this is really difficult to like thread the needle of general advice on a podcast when of all of the things around this topic, like this is the mother load of it depends.
Yeah.
Right. This is like, completely. It's so specific to the person. Mm-hmm. And the first thing that I think of when it comes to this is personality is such a factor here.
Mm-hmm. Yeah.
Because
what you value.
Well, what you value, and are you already a super saver? Mm-hmm. Like, are you already so sometimes okay, are we going to go down to side quest? I think this is going to be helpful.
Let's go.
I think this is going to be a helpful side quest.
Yeah, and we'll just use this prep for the long podcast we'll do on this.
So I heard this concept last year on a podcast, one of my favorite ones, Modern Wisdom, and he talked about this idea of advice. How did he phrase it? Advice hyper responders. Kind of this theory of like hyper response to advice. And what he talked about was, and I love this concept. I think it applies so much to what we do, is that the asymmetry of like advice and how people accept it. So let's just go down this for this example. When we talk about saving, how much you need to be saving.
Yeah.
And like setting guidelines like 30 and 20% savings and all this stuff. The people who are going to listen to that advice are the hyper responders.
Okay. Yeah.
They're the people that are already thinking, I need to save more. Yes. I need to do more. Like
they resonate with it and they do it.
And they do it. And they probably go over the top where it's almost like this paradox where it almost like the people who probably need to relax a little bit are the ones who are going to respond to it. Yeah. And the people who are not going to save anyway aren't listening.
Yeah.
They're just like, whatever. Yeah. Like I'll save tomorrow. I'll save later. It's kind of an interesting concept. So when we talk about 30 total term, I think for the people who are going to listen to us, the hyper responders, it's way too conservative. For the people who need to hear it, I'm like, No, you probably should try to shoot for a 30 because you're not going to hit it.
No,
but you might as well set that bar a little bit farther. It is conservative, but you're going to get if it gets you 2/3 of the way, you're going to be okay.
Yeah.
So I hope that all makes sense.
It makes sense.
Just if we're just saying generally speaking, where should you be shooting? I think 30 is too conservative of a goal.
Yeah, it is. Like you said, it depends so much. I'll give you an example from a call I was just on this afternoon. It's a client, mid-career, doing well, ahead of the average dental curve, on par with what our clients typically do. But his savings rate is 10%. Yet, because of the size of his net worth and the dollar amounts, his 10% is a high dollar amount, though, because the income's really high. So those dollars compounded, projected out, combined with his existing net worth and the other growth of his other assets, are going to be adequate. And it's highly likely, he's in his 40s, by the time he's in his 50s, if he's not done already, it's highly likely he technically won't even need to save any money. The momentum alone will continue to carry him. And this will be the case for quite a few people, where technically, you don't just go spend money just because you don't need to save anymore. You just whatever. But it will be the case where some people don't even have to save anymore. The momentum they've built in the first half of their career will carry them. So like you said, it's a very, very it depends kind of question, because just one flat number, 30 total term, 20% savings rate, that's not enough to tell a whole story. Also, are you retiring at 65 or 45? If it's 45, you better hit a 30 total term. You just have to.
By the way, it's now no longer TT. It's now RR.
RR, retirement readiness. Yep. It would teach the audience a new language.
The thing is that's kind of what we're shooting for, is we're moving towards
retirement
clarity as opposed to cleverness, where it's like retirement readiness is self-explanatory.
Perfect. Yep.
So
yeah, and you'll be seeing more of this in some of our content and our website, if not already, right?
Yep.
Some of these just the new ways of talking about it. But it's like, what age are you trying to be ready for retirement and be done? If it's your 40s, it better be close to a 30 score. If it's your 60s, we're starting. Okay, that's one thing. Here's another truth, though. If you look at the ADA's data, dentists are not financially prepared even up to 70 years old. They're not ready to retire, just based on the ADA's own data. So we know, and there's reasons why probably many dentists continue to work later in life that aren't just financially related. But we know that money's a problem. A lot of people would stop working if they could in dentistry. So we know that, like, the average dentist is not hitting even what we would call a 15 or a 20 retirement readiness, or TT for the old schoolers. It's not like everyone's hitting a 20 or a 25 and they're like, I don't need to push to 30. They're underprepared. So to your point, what I still like about even a conservative goal is, even if we don't need to hit it or we don't hit it, all it means is you're just going to be, that retirement readiness will just hit it at a younger age in your life. That's all it means.
Yeah.
And if along the way you haven't sacrificed a good life, you get to spend, you get to travel, you get to live where you want, which most dentists can. It's all timing. If you haven't sacrificed living a life along the way, then I like that people have pushed themselves, because statistically the facts are dentists spend more money than the average person by quite a lot.
Quite a bit.
And which means you just have to have more money later to be able to spend like that. But back to this point, I should read Taylor's comments actually. That's a very conservative target. A 30 retirement readiness or TT score, a 4% withdrawal. That is conservative, and recent data would tell us that that's true. So I'll pause there. Well, what else would you have to say? I'm going to look at Taylor's comments here.
Yeah, I mean, I think everything you said is spot on. And I just, again, it's just so personal to and so dependent on the person, their personality, their timing, their goals.
Mm-hmm.
If I, again, generally speaking, I would if someone said, okay, you've got to select like a new, either keep it at 30 or select a new kind of baseline or new guideline, I would probably say 25.
Yeah.
Would be the ultimate kind of, if I'm just saying generally speaking, you should be shooting for a 25 outside of your home, by the way.
Yeah.
So I think before,
that's something Taylor brought up, I was just going to add in.
Yeah. So the 30 total term, I think we always kind of assumed, or maybe just didn't really point it out very much back in the day, that more 30 included your home. I think in most cases, if we're saying 25 outside your home,
it's almost like a 30 with your
probably
home.
A 30 with your home.
Is. Yeah.
So I think it's still for a youngish dentist, let's say in their late 30s, early 40s, still mid-career.
Mm-hmm.
Someone just is like, what am I shooting for?
20% savings rate, 25 retirement readiness
yeah,
score.
Yeah, 15 to 20% savings, and I'd say about a 25 times your
annual
spending
in net worth, usable net worth.
Net worth.
Yeah, I think it's a great guideline, and it takes into account some of the new numbers, but also it takes into account the humanness of an entire life and career and wealth building path, which has so many twists and turns and unexpected things. And for people who are spending a lot of money, you can't expect that you won't spend that much later.
Yeah.
Once you're used to that, even when you start to imagine, mortgage payment will be gone or student loan, some payments will be gone, some kids will be out of the house, but you're used to the life that the $25,000, $30,000 a month, you're used to what that life feels like in little ways, the Amazon orders, the big ways, the house you live in, the stress that you feel or don't feel. You're used to that life. And so it's just statistically highly likely you'll continue living it. So
yeah,
got to save
I think
more.
that you mentioned, you just kind of alluded to it earlier too, like don't let this come at the cost of living a good life now.
Yeah.
And we know Donald, and he's amazing. And that personality that is like an optimizer. And so, which is great. I think that works for him, which is why I think I brought up initially, like personality matters here.
Yeah, it's like, very, very personal.
Very personal. And again, the risk of getting too optimized and too locked into the numbers, we've seen this. Even when you achieve whatever that number is, 25, 30, whatever it is, then the challenge begins of, okay, what do I do now? And how do I physically get myself to actually spend money that I've built up when I've been in this like super saver mindset?
It's hard either way, man.
But again, this is why this is a whole other podcast.
Yeah, Donald's comments back to Taylor was, did you just tell me to YOLO my money?
To YOLO?
Yeah, it's like, yeah, that's what we're telling you.
Well, we keep teasing this, and we want to do it. We're going to do it as a Die with Zero podcast book review.
Yeah.
Because that book has just gone.
I was just going to say,
bonkers.
Do you feel like the idea, this is just my anecdotal experience of being an advisor. I feel like for a long time, there was a lot of like legacy, leave behind a lot of money, die with a lot to pass along, which still exists. It's very personality driven. I think it's probably overrated, my opinion too. But also it feels like that's changing. A lot of my clients, as time goes on, are asking more and more. Even people who have the money to leave behind, they have enough, are starting to ask like, do I really, like, how do I make this so I use most of it?
Yep.
It seems like that's becoming more common. Is that just, maybe that's just my bias?
No, I think you're, no,
so like the world, is it like society, generational? Like what's happening there?
Total shot in the dark. So first of all, I'll say anecdotally, I feel the same thing. I'm hearing this a lot more. It feels like the tides have shifted more to this die with zero mentality. Not that people truly want to die with zero. I think there's still a feeling of like, I want to leave them something, but I don't know if it was like, I think my answer for all this stuff is always like, things changed after COVID.
Yeah.
Like, like
true.
It's kind of like the Bitcoin fixes this equivalent of like COVID changed everything.
Yeah.
But I think it really did. I think a mindset shift across society on many levels happened during COVID. And I think this might've been one of them. And then obviously this book, I don't know when it was published.
I know,
but I can tell you that it's made the rounds, and like
it got picked up somewhere on social media.
I don't know if like the Mormon Secret Lives of Women or something.
Yeah, that's not even close to the title, but yeah, you got it. I got the gist of it.
Secret Lives of
Mormon Wives.
There you go.
You got it. Wildfire.
I don't know if they like did a book club about it or something. Whatever it is, it picked up steam. It's everywhere.
Yeah, I want to see I feel like this book came out
a few years ago, I want to say.
Yeah, it wasn't that recent. When was Die with Zero published? 2020.
Yeah, there you go. There you go.
Interesting. July of 2020.
I think one of the stats from that book that has resonated the most with me, and I've heard this referenced by a lot of people to this, and it goes along with this exact idea of like retirement readiness, and because the other part of this too, when we talk about a 25 or 30 total term or retirement readiness number, we are talking about assuming that you want to leave money to your kids.
Mm-hmm.
So, because if you don't, that number can be much lower.
Mm-hmm.
If you truly are wanting to go die with zero strategy, then you don't have to be shooting for a 25 or 30. No. You could be shooting for more likely like a high teens or 20.
Yeah. 18,
it's going to
20,
increase your risk.
20. Yeah.
Overall of like a bad market stretch or something.
Mm-hmm.
But if that's your goal, then more power to you.
Yeah.
So, and I think that's starting to become maybe more of a thing for people. But to this point of like leaving a financial legacy, I think the stat from that book that really resonated with, again, me and a lot of people was the average age of when you actually inherit money.
Oh, yes.
And I don't remember the exact age. I'm going from memory, but I believe it was something like late 50s.
Yeah, it's older.
Or like early
it's almost
60s.
Near retirement age.
Like early 60s. Yeah. And he talked about this of like, think about that for your kids. Like, do you think your kids at 55 or 60 are going to need that money? Or are they going to need it now when they're in their 20s and 30s?
Yeah. When will they need it, appreciate it the most?
Yeah.
Oh, yeah.
So if you're going to be if your goal is to leave a financial legacy, why don't you enjoy it with them?
Start taking like your young adult children who are still in college and struggling and building their careers and dreams and like, travel the world, help them with their first home, like whatever it is, start a business, like whatever it is. It could be a lot of things. Probably more meaningful to a younger person still building their life than a 60-year-old, 65-year-old.
I last thing on this too, I'd say is whenever this topic comes up, I always think like there's so much, like, I don't know why. I mean, I do know why, but people always default to when they talk about leaving a legacy or this idea is like their number one value. It's always monetary.
Yeah. That legacy is $4 million. Yeah.
There's so many things. I would say when it comes to leaving a legacy, money's bottom of the list.
Yeah.
Of like what you should be thinking.
I think like, what would I want my grandkids to like remember me for?
Yeah.
They're probably like money, dude.
Yeah.
But like,
they're like,
I would choose something different.
Maserati.
Yeah.
Gramp.
I'd be like, which one of my grandkids, embraced the ocean and surfed?
Yeah.
That would be so cool for me. But they're like, no, I would have taken money. What are you talking about? Surfing? I can surf when I'm rich too,
Yeah, exactly.
Probably easier.
Well, and again, it can be money, but to me, it's you're either leaving money or you're making memories, and both cost money. So you're leaving money regardless. But to me, it's if money is the answer, if you're like, I want to leave money, well, they're either going to take that money, because I think the end of the day, the whole purpose of money is to get spent, and the highest return on that experience is making memories. So if the goal is to spend money or have your kids take that money and spend it on something, living a good life, do it with them.
Yeah.
Make the memories with them. That's the best investment you can make. Multiply that money.
I completely agree.
All right. We just added a fifth, I think, at the end there.
It was something in there. Well, do you need to hit a note for the fifth one?
I don't know. I feel like these are all going to get edited and we're just going to get right.
This whole podcast will be us referencing these different noises that never happened. I think they should be left in here. It's what the people want.
I don't think so. Do they? I don't know. Should we hit one for good luck?
Yeah.
To close us out? Oh, that was an airy one. Hang on.
For my part, I will say DennisAdvisors.com/podcast and ask us some questions there. Go to Dennis Advisors discussion group on Facebook, post some questions. If you want to chat with us, talk about any of these things in your more personal, it depends kind of situation, then just book a free consultation. And we'd love to have a talk with you about your life and your goals and what you're trying to do and help point you in the right direction. Matt, anything else coming up this year we want to talk about? Any other
some happenings? Some big things happening.
I feel like it.
The third annual Dennis Money Summit. If you like conversations like this, minus the antics.
More elevated. Not just due to elevation, actually.
Yeah, literally elevation. We love this. This is our third year. We're in a new place this year. This year it's in Midway, Utah. For those of you that are like, where's Midway? Basically think Park City. Yeah, Park City, but a little bit further up the canyon. A beautiful area.
Yeah, so pretty.
And our goal with the summit, the Dennis Money Summit, is to make it feel like a vacation, but you still are there to get something of value bring your family,
Mm-hmm.
get CE,
so much to do. It's so pretty that time of year.
And we're going to have so many activities.
So good.
The theme this year is practice on your terms.
Mm-hmm.
So you can get more information. You can sign up at dentistmoneysummit.com. Back by popular demand. No, not me. Dr. Daniel Crosby.
Matt Mulcock,
I'm coming back, but Dr. Daniel Crosby is going to be there again.
Excited.
We had so many. He was in year 1, and so many people were like, "You got to bring him back."
Mm-hmm. That might even be a state of residence by the time our summit rolls up. Yeah,
it is going to be by the time. Yeah, I talked to him the other day, and he will be back. He'll be living in Utah by then. Which is
all right. He'll just drive up from his house.
Drive up. Okay. Exactly.
Yeah, we're stoked.
Be awesome. DentistMoneySummit.com.
Okay. Well, thanks for everyone for joining us, Matt. Thanks for adding the color commentary today and all the good stuff in between. Thanks, everybody. Catch you next time. Bye-bye.